Home builders have been enjoying a strong run, but our next guest is feeling cautious about home builder stocks going into 2024, leaving investors wondering if the rally is finally over. For more on the home builder landscape in 2024, we're talking to Jay McCanless, Wedbush Securities housing analyst. Jay, it is good to see you. So I'm looking, Jay, at the XHB, the home builders ETF. It's basically flat so far this year, Jay, but listen, it's still up more than 40% over the last 12 months, but you're broadly feeling kind of cautious, Jay, about this sector. How come?
Yeah, good afternoon. Thanks for having me on. I think you said it, the big run that we had in these stocks, especially with the move that we saw in December, felt like we priced in a lot of good news. Also, we have the house view that mortgage rates probably stay where they are for an extended period. You look at D.R. Horton's earnings release earlier this week. They talked about having still a heavy use of incentives. Their gross margins were weaker than we expected as a result of that. So in an environment where the builders are having to do a lot of giveaways and mortgage rate buy downs, we just feel like at these levels, most of these names have priced in this good news.
Jay, talk us through supply and what you expect there in 2024. You know, how much are these guys going to be able to continue to build to meet the demand that there is out there?
Yeah, so nationally, the National Association of Realtors numbers that came out for December showed inventories of existing homes were only about 1 million in the U.S. right now. That's near the lows that we saw during the thick of COVID. You know, if we're right and mortgage rates kind of hang around this 7% level, probably don't see a lot of supply come on. That could work in the builders' favor, especially as they've been trying to bring prices down, in addition to rate buy downs, coming out with smaller footprints, more affordable footprints. That could help new homes continue to take market share from existing, like they did in 2023.
I'm interested, Jay. You know, the Fed is expected to cut rates this year, and you know, I would think, Jay, that's a pretty great bullish tailwind for this sector, just in terms of lifting sales and margins. You know, builders can reduce the incentives. So is your point just simply, okay, that's a tailwind, but it's just simply priced in at these levels?
Yeah, I think that's part of it. I think the other side of it is that even though there is the potential for rate cuts out there, in terms of the actual effect on the 30-year mortgage rate, the 30-year mortgage rate has only come down, as of where the numbers are today, only about 100 bips. So homes are slightly more affordable than they were, but much more expensive than they were, say, a year ago or even 2 years ago. And we feel like with, again, the move this group has had, we've priced in a lot of that good news. And if we do see, and I think probably the risk to our more cautious view is that if mortgage rates do finally start to come down at some point, that will pull more people back in, potentially can make our numbers be a little conservative. But right now, with mortgage rates kind of stuck at 7%, just don't see a reason to get overly bullish on the space at this point.
That said, there are some names that you like within home builders, and one of them is one that I wasn't as familiar with, and as you point out, it's not as popular. It's a company called Cavco that does factory-made housing. Why is that one more attractive?
So Cavco is a name that sells affordably priced homes. According to the Manufactured Housing Institute, the average price of a single section home was $70,000 last year, in 22, and $210,000 for a double section home. You compare that to where existing home prices are on a median basis at almost $330,000 in the U.S. This Cavco is a name that sells a very affordable payment, which is what the manufactured housing buyer is typically looking for. We also think the balance sheet of this company, which is all a net cash balance sheet, significantly net cash balance sheet, gives them the staying power to weather some of the mortgage rate fluctuations that the manufactured housing market saw in 23, just like the site-built housing market saw.
I'm interested, Jay, when you look at these home builders, just as companies, have they become more efficient, Jay, in the last few years? Do their business models look different?
Yeah, I think so. And especially if you think about the enhancements that they've made to their websites. 85% of home searches start online now, and the builders, even before COVID, but especially as COVID took off, The builders made a lot of enhancements to their website. You can plan out a lot more things. You can get a visualization of what your home might look like on a given lot inside of a subdivision. So I think for the Gen Zs and the millennials who are solidly in household formation years, having those tools for digitally native buyers, I think it's been a great resource. I think the other part of it is the industry in general is finding ways to take lumber out of the houses and maybe take some of the build time out of the houses through engineered wood and other products like that. So making the house stronger and a little faster to build. So yeah, these are much more efficient companies from that perspective. But I'll also say that the balance sheets of the majority of the names we cover are in much better shape than they were 5 years and especially 10 years ago. So building the houses a little smarter, as well as running it more efficient and less debt on the balance sheets.
Jay, thanks so much for joining us today. Really appreciate you
Thank you.
helping us kind of think through this sector. Have a great weekend.
You too. Thanks.